Hey everybody, I hope you're doing well today. Well, now let's take a look back at the same visual that you looked at the beginning of this series to get a further understanding of balance of payments. So here we go. Okay, so here is the same visual, right? We have balance of payments is divided into two broad categories, as you know, right? The current account, which is the balance of payments, right, of the balance of payments is the sum of the balance of trade in goods, the balance of trades and services, income flows, right, minus the outflows, and current transfer flows minus outflows. What does that mean? Well, that just means that all of that current account is a sum of all of these interactions, right? Remember, the white arrows are cash leaving Italy, and the yellow arrows are cash coming into Italy. Okay, so the current account is a sum of the net goods and services, the net incomes, and the net current transfers. And as a result of that, this number, right, could be in either a positive number or a negative number, depending on whether or not there's more money coming in to Italy in the yellows for these three categories, or there's more money leaving Italy out the white arrows. Okay, so if there's more money coming in, of course, then you would say that the current account is in surplus. If there's more money going out, then there's a deficit. Super simple, yeah? You got to know a lot of different language, and got to know that what the goods and services are, income are, and current transfers. But ultimately, what matters is there more money going out of Italy or coming in? And that'll give you a positive or negative number over here. Beautiful. Okay. Then the other component of balance of payments, major component, is the financial account, right? And the financial account is the sum of the net flows of income or net flows of cash and direct investment and portfolio investment. And in this particular example, I've taken the capital account, right, or capital transfers, and put them in here underneath the financial account. So you could think about these as separate, or you could think about them as one. It depends on the source. But either way, I like to think about all of these as one, and really the capital transfers, this item is rarely significant in the overall equation. Okay, so what does it say up here about financial account? Well, this is a sum of the inflow or the outflows of investment going abroad. These would be like Italian companies investing in land or some sort of direct investment in another country somewhere on the planet. And the yellow arrow is money coming from outside of Italy into Italy for some sort of direct investment. Beautiful. And then these arrows, of course, are about portfolios. Portfolios are things like stocks and bonds, and I like to keep it, there's more than that, but I like to keep it really simple just for understanding. Check out your course companion for more information if you want more details. But this is cash flowing out of Italy being invested in portfolios elsewhere. And this is, say, like in the New York Stock Exchange, and this is money coming into Italy being invested in, make it the simplest example, Italian companies buying stock in an Italian company. Okay? Beautiful. And then down here we have a white arrow going out, and that's capital transfers abroad. So these are capital transfers leaving Italy and going somewhere else, and these are capital transfers coming in to Italy. And I'll leave it to you to find that definition. So you take all of these, right? Because I don't want to talk about the definitions here. I want you to, the overall idea, the idea of this summary video is that you already know those things. And then if you take the sum, right, of this, right, the sum of the outflows and the sum of the inflows, and you end up with a positive or negative number. If the number is positive, the financial account will be in surplus. And if the number is negative, then the financial account will be in deficit. Okay, so take that information and take a look down here where it says, now we're talking about official reserves account. Well, what does this mean? Well, it means that if the current account, two scenarios, if the current account, that's this column, plus the financial account, that's this column, and we're taking the capital accounts in with it, putting the capital accounts in with it, if the sum of those two things is greater than 0, right, a positive number, then the official reserves will rise. Why would that be? Because if you think about all of the money coming into Italy on these yellow pipelines, if the number is positive, that means there's more money coming in the yellow pipes into Italy than there is money going out of Italy on the white pipes. And therefore, at the end of the year, there will be more money piling up in Italy, more cash. Okay? So take an example, this ridiculous example. Say at the beginning of 2015, there's 100 euros sitting in Italy. All of this transactions start, all this stuff happens, and at the end, right? If there's more outflow, more inflows, more yellow transactions than white transactions, then at the end of the year, there will be more reserves. There will be 125 euros sitting in Italy. And therefore, official reserves will rise. If the current account, on the other hand, if the current account plus financial account is less than zero, then obviously the official reserves will fall, and this would be the opposite case, right? This means that more money left on the white train, and the white arrows, the white pipelines, then came in on the yellow train, yellow pipeline. So what does that mean? Well, think about it. There were 100 euros here at the beginning of 2015. At the end of 2015, if more left than came in, then the official reserves account would go down to 80 euros. And of course, this would be like in the billions of dollars, right? But the point is the same. Okay. So all this then sorts out to the current account plus the financial account plus the capital account plus the change in reserves will end up equaling zero. And to explain that, because I don't want to get into too many details in this video, because I'm trying to make it as short as possible, to understand how the change in reserves will affect the balance of payments, check out the video on the relationship between the balance of payments and exchange rates and the flow of money based on whether or not there's a surplus, which would be the case over here, or a deficit overall in the balance of payments, okay? So, beautiful, my friends. That is the overall view on a balance of payments, a visual understanding. Remember, quite simply, that this title of this section could not be called balance of payments if the answer wasn't zero. And then, in summary, of course, economists have the beautiful bailout, and I love this about economics because it makes it really intriguing and imperfect and gives you a lot to talk about both in class and at home. If those numbers don't actually work out to be zero, then economists just figure, oh, well, there's been some omissions. There's been some errors, right? Net omissions and errors. I love that about economics, and that's what will make up the difference in any sort of accounting numbers, so that the balance of payments always works out to be zero. All right, my friends, I hope you found this summary video of balance of payments using a visual as helpful, and I'm looking forward to talking to you in a bit.